Hello and welcome. My name is Matthew Stearns. I'm the founder and lead advisor here at Brookhouse Advisors in Meadville, Pennsylvania. We have a special presentation for you today. This is for clients and the public that I call Into Thin Air, a look at U.S. stock market valuations and all the things that I think investors should be keeping their eye on right now as we head into the second half of summer. So just as a disclaimer for today, this presentation expresses my views and that of Brookhouse Advisors. There's no guarantees that they will be accurate. They may, of course, prove to be wrong ultimately. And none of this presentation has been reviewed for accuracy by FINRA or the SEC. And my registration with the state of Pennsylvania does not denote any level of expertise. Okay. Certain market information that's in this presentation was obtained by public sources, and I believe those sources to be accurate and reliable, but I do not assume responsibility if they are indeed not. I think they're close enough to be useful. And this presentation is for informational purposes only. This is not investment advice. I'm going to be giving you a lot of data and facts, but I'm not going to be telling you what to do. I think it's important to just know where we stand in this particular environment, and that if you're watching this, you should be in conversation with your own professional, your own financial advisor, understanding the risk that you're taking and the suitable of the investments that you have. So today we're going to be talking about the valuation of the entire U.S. stock market. And by U.S. stock market, I'm going to primarily be referring to the S&P 500. The S&P 500 is the 500 largest companies in the United States by market value. But we're going to be talking about the entire market for all intents and purposes, which would be anything within inside the top 3,000 stocks in the United States stock market. And there's a couple very basic valuation metrics that we use to determine the valuation of a company based on historical factors. Okay, again, these are the economics 101 valuation metrics. So this, you shouldn't take these ratios and go and look at an individual stock and say, oh, this stock's expensive or this stock's cheap. It's not how it works. But today we're going to be talking about these ratios because when they're looking at an entire market, they provide a little bit more context than an individual stock that has a lot of individual circumstances and nuances that need to be considered. So price to earnings ratio is quite simple. It is literally the value of the company divided by its net income over the last 12 months. So you take its net income, its price, okay, and then that gives you a ratio. It might be 10, 20, 30, 40 times its earnings. Okay, so you could say a company has a P/E ratio of 40. It is priced at 40 times its net income in that situation. Okay, and then we also have price to sales. That is pretty straightforward. It's the value of the company divided by how much sales it had in the last 12 months. Okay, there's a lot of types of valuation methods, too many to count. Price to free cash flow, which is a little bit different than earnings and net income. You have forward PE, so projecting what the future 12 months is going to be, etc. But the classics that we're going to be talking about today are price to earnings and price to sales. Okay, so we're going to start by looking at the historical price to earnings ratios going back to 1988 compared to where we are today. You can see that we've had quite a bit of oscillation throughout the last 36 years, as low as a 12 PE ratio in 2010, 2011, and now we're at about 26. The historical median that they're showing here is 18.5. If you went back to about 1900, the average PE ratio would be 15. So somewhere between that 15 to 18 mark is historically relevant, or about what the average has been. And the reason that it's 15 to 18% is for a very good one, and that is that investors, people that are purchasing businesses, whether it be shares or entire businesses, are only willing to pay a certain amount of the earnings multiple to purchase a business. It's quite fundamental. If you were an investor buying a small business in your local town, how much would you be willing to pay if they were making if they were making $1 million in net income, how much would you be willing to pay for that business? If they're making $1 million, would you be willing to pay 5 million? You know, it would take you 5 years to get paid back. Would you be willing to pay 10 million? It would take you 10 years to get paid back if they kept that current rate. Well, historically, in the fastest growing companies, because these are the top 500 companies in the United States, people are willing to pay about 15 to 18 times their earnings, okay? 15 to 18 times their profits, okay? The reason why that number is a lot higher than you would think logically is because these companies are growing at a fast rate. That's why they've become one of the largest companies in the United States. So in that situation, you're saying, okay, I'm paying for 15 times their earnings today, but in 5 years, I expect their earnings to be double that. So I'll pay 15 times today's earnings. Okay. Whereas if you were buying a small business, most small businesses, in fact, only sell for about 3 to 5 times their earnings because you don't expect that much growth on it. So if some company was making $1 million and you wanted to buy it, it'd probably only be worth $3 to $5 million. Okay. This is how valuations work because they're rooted on the fact that if someone was buying your company, they wouldn't pay an infinite amount for that company, right? They would pay a certain amount of future cash flows, and that number is typically around 15 to 18 times, okay? This is one of the most mean reverting things over a long time frame that the markets always return to because it's a logical number to be willing to pay for future growth of a normally growing organization. And profit margins historically are around 10%. So if you have a company growing at 10%, you're buying a large company, you're on average willing to pay 15 times for that. Now, an individual company might fetch a higher multiple, a higher PE, because they're growing at a 20% or 30% clip. But that's the risk of investing in a growth stock. You have to monitor how much is that company actually going to have to grow and how many times their current cash flow, their current net income, and am I willing to pay to own that company? This is the fundamentals of investing. And right now, the S&P 500 is at 26 compared to an ordinary number of about 18 to 15. So it's about 40% overvalued based on this metric here. Next, we're going to look at a price to sales ratio. And the price to sales ratio is very straightforward. What's the value of the company divided by its sales? That's the ratio that we're looking at here. The historical number in this chart, we're looking from 2000 to today. The historical number going back to 1900 is closer to 2. So we've actually been a little bit lower than the median, largely because of the financial crisis in 08. So today you can see that the price to sales ratio is well above the median at 3%. And like I said, historically it's actually about 2. So on this metric, the price to sales ratio today over the last 12 months is about a third to a half to 50% overvalued as well. All right, this is a great slide and one that I really want to focus on today, and that is looking at the price to earnings ratio and the price to sales ratio of different slivers of the market. As we mentioned 2 slides ago, the S&P 500 today is at 26 in price to earnings. The average is about 18 to 15, okay? The equal weighted S&P 500 is a little bit different than the S&P 500. The S&P 500 is weighted. If the size of your company is larger, you comprise a greater percent of the index than a smaller company. So Microsoft is 6% of the S&P 500, for example, and Disney might be 0.5% of that index, for example. Whereas the equal weight, they all share the same weight. So they're all worth, 0.2%, for example, across the board. So the equal weight's a little bit cheaper, still overvalued related to historical levels. The Russell 2000 is your 2,000 smallest publicly listed companies. So the smallest 2,000, kind of the smallest 2,000, it would be technically the Russell 2000 is the 1,000th largest to the 3,000th largest stock. So we call those small cap stocks. You can see it's at 38 times. The NASDAQ, which is comprised of mostly technology companies, is at 44, but this is the big one, folks. The Magnificent Seven, the 7 stocks that everybody loves: Tesla, Nvidia, Meta, Google, Apple, Amazon, Microsoft. These stocks are trading at nosebleed level ratios of price to earnings, meaning people are willing to pay 53 times their net income today, which is at all-time highs, experiencing extreme levels of growth in most cases, and they're at a 53 multiple relative to a normal amount that would be 15 to 18%. And I know what people are saying. The first reaction is saying, well, these are great growth stocks. They've been growing so much. In fact, large companies, think about Apple. They've been around, for almost 50 years. They get so large that they actually normally experience slower growth than a company that might be the 400th largest company, and that's really kind of moving up the ladder. You get to this size and scale that it's just hard to grow a $3 trillion business as fast as it was when it was a $300 billion business, okay? It's just a matter of mathematics. So what should normally happen is that the largest companies should have an even lower multiple than the smaller companies. So the fact that the largest 7 companies have a 53 multiplier is people are willing to pay 53 times their earnings is something to really think about, okay? Let's look at price to sales. You can see in this situation that if you recall, the S&P 500 is at 3 right now. The historical average is 2. You have the Russell 2000 small cap stocks and equal weight 500, fairly or even undervalued by this metric. But then look at the NASDAQ. You still have the NASDAQ almost, doubly more expensive than normal. And then look at the price to sales ratio of the Magnificent Seven. It's just unbelievably high. This is because they've been earning really high profit margins on their sales. So their earnings ratio looks closer than their sales ratio does, but their price to sales ratio right now is about 5 to 6 times, let's call it 6 times the average. 6 times the average. So you're looking at, an 80% decline in that metric to get back to normal levels. Here's another look at the 5 largest stocks in the S&P 500 looking back historically. This goes to 1964. And you can see that right now we have a very large concentration in our top 5. About the top 5 comprise roughly 30% of our stock market. You throw in the rest of the Magnificent Seven, and they're over 35%. Okay, so these companies are making up a huge chunk of our market, a disproportionate size, and it hasn't been this big until you have to go all the way back to the 60s. And you can see that there is a kind of trend here. There's a growth and a decline as these things kind of rotate. So this isn't something that is historically normal. There is, however, precedent for it, but the precedent is that these things usually, wean themselves out over time. But this is important. It's something I'm going to reiterate in this presentation. Just because this was the high in the past does not mean that it can stop here. These companies could become 50%. They could become 70% of our stock market. Nobody knows how far this is going. This is not me here saying, these stocks are way too big, you should sell them. That's not what I'm here to say. What I'm saying is you should just be aware that these companies are representative of a huge amount of the S&P 500. If you own the S&P 500 index, you have to understand that a third of what you own is in 7 companies. Okay, 5 to 7 companies. That's what I'm here to tell you. That's all. This metric can go very largely, a very large magnitude in one direction or the other. Okay, there are some cautionary tales, however, that I think are worth mentioning. And this is related to a point that I think is really forgotten by investors. And in this chart, we're looking at Cisco in 2000 and Nvidia today. Now, in 2000, we had what was called the dot-com bubble. And that bubble was really focused on the internet and how much the internet was going to change our economy. And we're here 24 years later, and the internet changed the economy massively. I mean, massively, just like the Industrial Revolution changed the economy. Okay, so massive, massive change. But what happened in the 2000s, the late 90s and 2000s, everybody said, oh my gosh, this internet, it's so revolutionary, it's going to change everything. Let's just buy all these stocks and let's buy it indiscriminately. I don't care how much it costs. Buy, buy, buy. And at that time, Cisco was really the leader of internet servers, and they're still around and they still, apply to a lot of the aspects of the internet. But what happened was people forgot that it mattered how much you paid for the company. So Cisco, even though it's still around today, even though it is much more valuable today than it was in 2000, you can see that we have an overlapping chart here. This is the white line is shifted 24 years ahead. You can see how steeply that that stock price went up in 2 years, and it was just this massive bubble that was formed. And then you can see over the next 2 years that stock price corrected 80%. Now, were people wrong about the internet? No. They were absolutely right. Were people wrong about Cisco? No. Great company, still around today, worth much more than it was. But people were wrong at that time to pay any amount for the company, even though they were part of this earth-changing technology. And this is something that so mirrors the situation we're in today. And I think wisely, this chart overlays this with Nvidia. Nvidia is right now the second or third largest company in the United States, in the world. Well, we'll say United States for now. Um, and you can see the meteoric rise in their stock price. Now, Nvidia, they make semiconductor chips, so they go into a lot of computer applications, but they're really making a lot of money from artificial intelligence applications and crypto. Two of the most, iconic things, the most buzzworthy, trending things right now that probably are going to make a huge impact in our world. But here we are again, and people saying, "Oh man, this is such transformative technology. Nvidia is the biggest player. I gotta own Nvidia." And right now, Nvidia, its company value is they have this as a percentage of GDP of the United States GDP is about 12%. So their impact on the economy right now is valued at 12%, and Cisco's was 5.5 in 2020 and 2000, and their stock price corrected about 90%. It went down 90% from the peak, and you can look at the magnitude of this Nvidia stock so far this year. So it's just a really important reminder that you can own a fantastic business, you can own it in the most fantastic industry, doing the most groundbreaking thing. It still matters the price you pay, and it will always matter. The return that you earn on an investment is a function of the price you pay. And it's not worth an infinite amount. It's only worth a certain amount. Okay, so just be very aware of that today as things seem really trendy and are moving very quickly in either direction based on word of mouth or the new buzzwords. Just think back to this chart. Okay, so now we're going to take a look at Apple, who's been more of a stalwart. They've been around a long time. So a different type of chart here, but we're going to look at the individual PE ratio of Apple. You can see here, this chart only goes back about 8 years, but even in the last 8 years, Apple's price to earnings ratio was averaging about 21. Right now, it's at 35. Okay, just keep that in mind. EV to EBITDA ratio is quite similar. It's basically looking at the price to earnings ratio, but then excluding depreciation and amortization and interest expense. And you can see that its average was 15 and it's at 26, 27 now. And then look at the price to sales. The price to sales is normally 5% over the last 5 years, or last 8 years, excuse me, and now it's at 9.27. So all of these metrics are almost, 60, 80, 100% overvalued, okay, in these metrics. And this is Apple. And the interesting thing about Apple is in the last 2 years, since 2022, Apple's revenues have not grown. They have not sold, their sales have not increased in the last 2 years. They've flatlined. If you look at their revenue chart, zero growth. Apple right now is a zero growth company, and we don't know if they're going to keep growing, quite frankly. Yes, they have a dominant product, but many of the world can't afford their products, and China's making excellent phones that are very comparable. I lived in Hong Kong in 2014, and at that time, the Chinese were already switching, their preferences to the local phones. And I saw a lot of my European friends. They bought them, they took them home. They love their phone. Okay, it's very good, and they're selling it 25%, 50% of the price. Does Apple have a permanent product that they can make, that they can grow infinitely at 15%, 20%, whatever it may be? I'm not sure. But Apple right now has a PE ratio of 35. They're not growing. They haven't grown for 2 years, and the average is probably around 20 for them, if you look back historically. Again, these are valuations. I'm not telling you what to do. This PE ratio can go to 70. I have no idea if that's going to happen, but just be aware of it. That's what this presentation is all about. All right, so here I'm going to bring you a couple more sobering charts. This one, well, both of them are by John Hussman, who is an economist that I greatly respect. He's also a mathematician, and he just does some phenomenal work, and he's been at it for a long time. He very precisely predicted that the technology crash of the 2000s, the dot-com bubble, like I was referring to with Cisco, would be extreme. In fact, I think he predicted that it would be down 83%, and it was exactly 83% correction in those dot-com stocks. And this chart that I want to look at today is really good because it looks at sort of an estimate. If you look at the x-axis on the bottom, what are we estimating the 12-year return versus what's actually happened historically? Okay, so this is in excess of treasury bonds. So whatever the interest rate you're getting on treasury bonds is, for example, it's right now it's between 4 and 5%. It would be so like what's the return beyond that 4 and 5%, for example? And you can see that there's a pretty strong correlation between the estimate, okay, and the actual. We've got a pretty linear relationship, okay? And he identifies the estimate, he calculates the estimate, okay, based on a proprietary valuation model that is really close to the price to earnings ratio, but eliminates banks, eliminates some certain sectors, and adjusts it based on profit margins, okay, and some other things, of that nature. But interestingly, in his chart, he is estimating that the 12-year annualized return of the S&P 500 is going to be about 10% less than treasury bonds, like I said, over the next 12-year time frame. Now, that doesn't mean every year they're going to underperform, and that doesn't mean that every year stocks are going to go down. That could mean that treasury bonds are going to do phenomenally well. Stock prices just might not do very much. Or it could mean both. Treasury are going to do great, stocks are going to do poorly. You don't know exactly what's going to happen by looking at this, but you can see, based on this data, that there is a strong relationship. Even, the dots that are furthest from the correlation line, that's really a little dotted line, they're only off by about 7 or 8%. Okay, and right now he's at negative 10%. So if he's as wrong as he's ever been, it's still saying that, or it's still inferring that over the next 12 years, the S&P 500 is not going to outperform treasury bonds. All right, here, John Hussman and his team also takes a look at valuations and looks at, what does the valuation need to be to earn a 10% normal return, nominal return. So not thinking about inflation, which would be the historical average of the S&P 500. What does the price need to be? What does the valuation of the stock market need to be to get us to that level that's consistent with expecting to earn 10%? All right. And in this chart, he says that that level is 1650. Okay, on the S&P 500. Right now, it's about 5,600. It's about 5,600. He's saying it could go as low as 1,600. Um, to get to a point where it's about a 5% premium over Treasury bonds, he's saying 1,700. To get to where Treasury bonds and the S&P 500 will return about the same thing based on valuations, he's estimating that the S&P 500 level needs to get to 2,600. So in this situation, John's expecting, based on the calculations of the valuations of the market, that there needs to be a pretty severe correction to return ourselves to a situation where the stock market is traditionally valued at a fair price. Okay, and that's what I want you to hear. For the stock market to be valued at a fair price, where you as an investor can expect a long-term 10% return, the market is just much, much too high to have that expectation. Okay, now that doesn't mean the market won't go higher in the future, but in the next medium time frame, if you're expecting those large returns, you may be mistaken. Okay, and this isn't, again, advice on what to do next, because you can see how far, that blue line that you're looking at, that graph, that's the S&P 500. You can see it kind of gets away from the green line, which is really kind of the normal level. But it's extremely far away today, and it can keep going to extremes. We live in a crazy world. We're going into extreme amounts of debt. Certain things in this economy can keep going in extreme ways, in extreme directions, further than anybody thinks is possible. So this is not a recommendation about what to do. It's not a recommendation to not own stocks. It's not a recommendation to own stocks or anything about the Magnificent Seven. This is a recommendation to understand that the market is historically expensive. Okay, there's really not two ways, that you can cut it up where that isn't the case. Okay, but we don't know what's coming next in the short term. But we can know how expensive it is, and we can also look at our portfolio and say, all right, what am I really at risking here? And that's the key question. It depends on what you have in your portfolio and how much you really have at risk, and if you're okay with taking that risk. Because, like I said, the market could keep going up. But do you understand the amount of risk you're taking for that growth, and are you comfortable with that? If you are, then stick to your investing plan by all means. If you're not, you need to have a talk with your advisor, and if he's not understanding it, you need to talk with somebody that understands these types of dynamics at a deep level. Okay? Just a few more things. So I kind of started this rant on the last slide, but this is not investment advice. This is about knowing what you own and understanding the risk that you're exposed to. Okay, I'm not calling for a market crash. I am saying the market's highly, highly expensive. I'm comfortable saying that, and it is most expensive in the biggest and largest and the flashiest names. That I think I can say, is a fact. Okay, and as an investor, you need to understand that if you own the S&P 500, you own a huge chunk of those names. They're the most expensive portion, and the other parts of the market are less expensive. Okay, you have to weigh and balance what that means for you. Valuations are not a good indicator in the short run of what's going to happen. The last thing you should do is take this and apply it to your portfolio tomorrow. Okay? Well, I should say that's the last thing you should do. But this is not indicative of what's going to happen in the short term. In the short term could be, in the next 24 months, okay? But valuations are mean reverting because investors can't pay an infinite amount for things. Investors are only willing to pay a certain amount for future cash flows. If you were actually buying an entire business, you would care a lot more about the price you're paying for it. If you had the money to buy, you know, Nvidia's company, you would not be paying, 60 times their net income to purchase the company. You would not be doing it. These are prices people are paying because they're betting that somebody else will buy the stock at a higher price. Okay, and eventually those things return to normal. Something happens. There's usually some type of catalyst. So valuations are predictive of long-term returns because so are profit margins and people's willingness, to actually purchase companies, which is what you're really doing when you're buying stock. So I hope, I put a good wrapper on that. And I hope you got a lot of this presentation about the valuations of the stock market. It's not to scare you. I'm not a bear. I'm not, rooting for the market to go down. But I am concerned about people's awareness of where things are, kind of how frothy the market is, and that, the long-term prospects are much reduced because the market is so expensive. And so there's an opportunity there in the future, and there's, more risk than normal here at our current time. So know what you own and understand your risk. All right. So that's everything I have for you today. Thank you very much. Thank you for watching this presentation brought to you by Brookhouse Advisors. We're a Christian investment company. We do active portfolio management. We actively manage risk for our clients. We also use faith-based investment options that align with Christian values. We do financial planning, retirement planning, 401k servicing for businesses, and much, much more. So if you enjoyed this presentation and are looking for some other opinions on your investments or financial situation, please reach out to us. You can find me at brookhouseadvisors.com, schedule a meeting there, or email me at matt@brookhouseadvisors.com. Thank you very much.